If you are between 55 and 65 and wondering whether you should really roll your 401k into an IRA, you have probably already heard the standard answer. More investment choices, lower fees, one clean account instead of 4 scattered logins from old jobs. For some people in this exact age range, that easy yes turns into a $32,500 mistake, and it has nothing to do with how the market performs. Most advisors push the rollover because once your money leaves the 401k and lands somewhere they can manage, it becomes billable. They call it consolidation. What they don't always mention is that consolidation can lock you out of your own money for years or strip away a federal legal shield that protects your account from a lawsuit. I've watched this happen to careful savers who did everything right for 30 years, then lost 5 figures in a single afternoon because of one form. We are talking about 2 specific things here: the rule of 55 and what I call the ERISA creditor trap. Roll over at the wrong time, or roll over too much, and you can trigger a 10% early withdrawal penalty on every dollar you touch before age 59 and a half. On a $325,000 balance, that penalty alone runs $32,500 money, handed straight to the IRS, that never had to leave your pocket. Over the next few minutes, I want to walk you through a partial rollover approach that gets you the investment freedom people actually want from an IRA, without giving up the legal and tax protections that only exist inside a 401k. If you are in that 5-year window before or after retirement, this is worth a subscribe. We spend our time on the specific rules, like the rule of 55, that quietly decide whether you retire on your terms or on the government's. Here's the rule most rollover advice skips. The rule of 55 lets you pull money out of your current 401k, penalty-free, if you leave that job in or after the year you turn 55. Move that same money into an IRA, and the rules reset. Now you wait until 59 and a half, or the IRS takes 10% off the top. That's the reversal most people never see coming. You leave your job at 55, feeling proud you don't need that money yet. Then, at 56, an unexpected roof repair or a medical bill shows up, and pulling from an already rolled-over IRA suddenly costs you real money you never planned to spend. Think of it less as a loophole and more as a switch. Your 401k keeps that switch turned on only while the money stays inside the plan of the employer you just left. Roll it into an IRA, and the switch turns off for good on that money. Here's the mini-math. Say you retire at 55 and need $60,000 a year to live on for 4 years, until you turn 59. Leave that amount inside your 401k, and you can pull all $240,000 with zero penalty. Roll the same amount into an IRA first, and that same $240,000 costs you $24,000 in penalties alone, before a dollar of tax. There's a catch worth knowing. This protection only covers the 401k from the job you just left. An old 401k sitting from a job you had at 45 doesn't qualify unless you rolled it into your current employer's plan before you separated from service. The IRS lays this out plainly in Publication 575, under the separation from service exception, and it's the detail that trips up people who assume every old account works the same way. There's a cost to staying in the 401k that's easy to miss. It buys you that penalty-free access, but it usually means fewer investment choices and a clunkier website than an IRA offers. That's a real cost. It's just a smaller one than $24,000. Notice this only matters if you plan to spend down that money before 59 and a half. If you've got a pension, rental income, or a spouse still working, the rule of 55 might not affect your decision much at all. The point isn't that everyone should keep every dollar in a 401k. It's that the decision should follow your actual spending timeline, not a blanket rule someone read online. A lot of people also assume this only matters for a full rollover. It doesn't. Even a partial move can shrink the cushion you were counting on. Say you only roll over $150,000 of that $400,000 balance, thinking you're being cautious. If your bridge years need $180,000, you've still left yourself short, and the remaining IRA money can't fill that gap without the same 10% penalty. Maybe the penalty doesn't worry you because you've got other cash sitting around. Fair enough. But there's a completely different reason to think twice before rolling over, one that has nothing to do with taxes and everything to do with what happens if somebody sues you. Your 401k carries a layer of protection most people never think about until they need it. It's covered by ERISA, a federal law that makes the balance in an employer plan nearly untouchable by creditors or a lawsuit judgment. Move that money into an IRA, and you leave federal protection behind for something set by your state instead. That's a bigger swing than it sounds. In states like California or Georgia, how much of an IRA is protected depends partly on a judge's read of what you reasonably need to live on, not a fixed federal guarantee. Two people with identical balances can end up with very different outcomes, depending only on which state they live in. Think about who actually gets sued. It isn't only business owners. A single at-fault car accident, the kind involving a teenager on a phone or a wet road, can produce a judgment that goes past what your auto insurance covers. According to the U.S. Chamber Institute for Legal Reform, civil litigation in this country runs past $529 billion a year, and that cost eventually lands on somebody's balance sheet. If yours is exposed, an IRA in the wrong state offers a lot less cover than the account it replaced. Here's the trade-off worth sitting with. A 401k can feel restrictive, tied to your old employer's menu of funds and its dated website. But that restriction comes bundled with a legal shield you can't simply buy back once you've rolled the money out. Your 401k behaves like a federal vault. Your IRA behaves more like a tent, and how sturdy that tent is depends on your zip code. It helps to check your own state before assuming either way. Some states, like Texas and Florida, protect IRA balances almost as fully as a 401k. Others leave the door open for a judge to decide how much of your retirement money counts as reasonably necessary, which is a very different standard than an unconditional federal shield. That single detail, easy to look up on your official state government website, can matter more in the end than which brokerage you choose. Maybe lawsuits feel like someone else's problem. That's fair, most years they are. But even if you never get sued, there's a completely different trap waiting in the same rollover decision. And this one hits anyone who still hopes to use a backdoor Roth down the road. If you earn too much to contribute to a Roth IRA directly, you've probably used the backdoor Roth, contributing after tax dollars to a traditional IRA, then converting them to a Roth. It works cleanly as long as you have no other traditional IRA money sitting around. Roll a $400,000 401k into a traditional IRA, and you've just made that door far more expensive to use. Here's why. The IRS uses something called the pro-rata rule under Tax Code Section 408DE3, and it treats every IRA you own as one combined account for conversion purposes. It doesn't let you cherry-pick the after-tax dollars and convert only those. Here's the mini-math. Say you contribute $8,600, the 2026 limit, for someone 50 or older, as an after-tax contribution meant for a backdoor Roth. with a $400,000 rollover IRA already sitting there, close to 98% of that conversion counts as taxable income, not the tax-free move you expected. Do that every year for a decade, and losing the tax-free growth on $86,000 worth of contributions can cost you $30,000 or more in extra tax down the road. I used to tell people to roll over everything for the lower fees at places like Vanguard or Fidelity. That advice wasn't wrong exactly, it was just incomplete. I hadn't accounted for higher income earners who lose access to the backdoor Roth the moment that rollover clears. This isn't a small niche problem either. Anyone earning above the income limits for a direct Roth contribution and still hoping to save more for tax-free growth relies on this exact maneuver every single year. Once a rollover IRA sits in the picture, the pro-rata rule doesn't reset the following year. It applies every time you convert, for as long as that traditional IRA balance exists, which means the cost compounds year after year, rather than showing up once and going away. Some people try to get around this by opening a separate IRA at a different brokerage, hoping the IRS will only look at one account. It doesn't work that way. The pro-rata rule looks at every traditional SEP and simple IRA you hold across every institution, added together as though it were one account on the last day of the year you convert. So where does that leave you? You want the fee savings and the fund choices an IRA offers. You also want to keep the Rule of 55 access, the ERISA protection, and the backdoor Roth door open. It sounds like you have to pick one. There's a way to get most of both, and it starts with a number most people never bother to calculate. Here's the approach that solves most of what we've covered so far, and it's simpler than it sounds. It's called the partial rollover, and it starts with one number I call your bridge number. Step 1. Take how much you spend each year and multiply it by the number of years between when you plan to retire and when you turn 59 and a half. Retire at 56 with $70,000 a year in expenses, and your bridge number lands around $245,000. Step 2. Keep that amount inside your 401k, plus a cushion of about 20% on top to absorb a bad year in the market or an unplanned expense. Step 3. Roll everything beyond that bridge number into an IRA. What you end up with is penalty-free cash sitting in the 401k for the years before 59 and a half, thanks to the Rule of 55, while the rest of your money gets the wider fund choices an IRA offers for the long run. Picture two versions of the same retirement. One person rolls everything into an IRA the day they leave work at 55. The market drops 20% the following year, and they're forced to sell into that drop and pay a 10% penalty just to cover groceries and a mortgage payment. The other person kept their bridge number inside the 401k. Same market drop, same age, but no penalty, and the IRA money gets left alone to recover instead of being sold at the bottom. That gap between selling in a down market under penalty and simply waiting it out is the entire case for doing the math before you roll over anything. Your bridge number isn't fixed forever either. Revisit it once a year, especially right after a big market swing or a change in your spending, like paying off a mortgage or picking up part-time work. Some years you'll need less sitting in the 401k than you thought. Other years, a new expense means you should leave more in place before rolling out the rest. One more thing worth knowing. Most 401k plans allow what's called an in-service partial rollover once you're past a certain age, even before you separate from your job. That means you don't always have to wait until you actually retire to start shaping this split between accounts, though the exact rules depend on your plan document, so it's worth checking with your plan administrator directly. There's one more piece worth knowing. Before you touch that rollover button, especially if any part of your 401k is sitting in company stock, it's a tax break that disappears the moment the paperwork is signed. If part of your 401k sits in your employer's stock, and that stock has grown a lot since you bought it, there's a tax break tied to the shares themselves that most rollover advice never mentions. It's called Net Unrealized Appreciation, or NUA. Move that stock into a regular brokerage account instead of an IRA, and you pay ordinary income tax only on what you originally paid for it. The growth on top gets taxed at the long-term capital gains rate, usually 15 to 20%, not your regular income tax bracket. Roll that same stock into an IRA, and this benefit disappears completely. Every dollar you eventually withdraw gets taxed as ordinary income, which can run as high as 37%. Here's the mini-math. Say you're holding $100,000 in company stock with a $10,000 cost basis. Roll it into an IRA, and withdrawing it later at a 24% tax rate costs you $24,000. Use the NUA approach instead, and you pay 24% on just the $10,000 basis, about $2,400, plus 15% on the $90,000 of growth, another $13,500. That's $15,900 total, a savings of about $8,100 on the exact same shares. That gap is real money, but it only shows up if you catch it before the rollover happens, because once that stock lands in an IRA, the NUAA option is gone for good. This only applies to company stock held inside the plan, not stock you bought on your own in a brokerage account, and it only works if you move the shares out in a lump sum distribution rather than a partial one. If you're not sure whether your 401k even holds employer stock, check your latest statement or ask your plan administrator directly, because plenty of people carry it for years without realizing what it's worth outside the plan. Before you make any final decision here, it's worth talking about why so many people roll over anyway, even after hearing all of this. It usually isn't about the math at all. There's a reason so many people roll over anyway, even after hearing about the Rule of 55, the ERISA protection, and the pro-rata trap. Psychologists call it simplicity bias. We want one login, one statement, one dashboard that shows the whole picture at a glance. That instinct makes sense. Keeping track of 4 different 401ks from 4 different jobs over 20 years is genuinely exhausting, and wanting to feel organized heading into retirement isn't a character flaw. It's a completely normal response to a messy situation nobody designed on purpose. Here's a small shift that helps. Instead of organizing for convenience, organize for optionality. 2 accounts, a 401k and an IRA, working together isn't clutter. It's closer to running 2 different tools for 2 different jobs, one built for legal protection and penalty-free access, the other built for investment choice. If your old employer's 401k website looks like it was built decades ago and takes 3 phone calls to log into, I get why that's annoying. But weigh that annoyance against a $24,000 penalty or a lawsuit that finds your account unprotected. A clunky login is a small price for that kind of coverage. There's also a quieter version of this bias that shows up in how people talk about their own finances. Saying I rolled everything into one IRA feels like an accomplishment, something you can mention to dinner and sound decisive about. Saying I kept some money split across 2 accounts on purpose doesn't carry the same social payoff, even when it's the smarter move. Worth noticing which one you're actually optimizing for. Before you touch that rollover button, run through 3 checks. Does the Rule of 55 apply to money you might need before 59 and a half. What does your state actually say about IRA creditor protection? And is any part of your 401k sitting in company stock that qualifies for the new A tax break? You don't have to decide any of this today. You can always roll over later, next year or 5 years from now, if that turns out to be the right move. What you usually can't do is undo it. Once that money leaves your 401k and your employer relationship has ended, there's rarely a path back in. I don't know your specific tax bracket, your state's laws, or exactly how your accounts are set up, so please take this framework to a CPA before you move 6 figures of your life savings. This video is meant to help you ask better questions, not replace that conversation. None of this makes a full rollover wrong for everyone. For some people, especially those without a big cash cushion for a lawsuit or company stock sitting in their plan, moving everything into an IRA is still the simpler, perfectly reasonable choice. The goal here was never to talk you out of an IRA. It was to make sure you're choosing it on purpose, with your eyes open to what you're keeping and what you're giving up. If you want the walkthrough on how to actually find the fees hiding inside your current 401k, something we didn't have time to cover today, subscribe and look for that video next.